Hi everyone, Steve Putt here. I just wanted to give everyone a bit of an update on my take on the Greek debt crisis coming up to the weekend. There's obviously been a lot of focus on the position of Greece and the bailout over the last few days, so I just wanted to give some ideas and give some thoughts on it. At the current position, Greece has not paid its $1.6 billion payment owing to the IMF, and the Greek banks are closed, and there's not likely to be any change to this situation prior to the referendum that's due to be held on Sunday. The surprise call of a referendum for Sunday will determine whether or not Greece accepts a loan bailout condition or not. If the referendum is passed, it'll likely send a bit of a signal to the government to engage constructively with the rest of Europe to provide funding and then work with the creditors to put Greece's debt burden on some sort of more sustainable footing. A yes vote, however, would not provide immediate resolution, as it is very likely to now mean a new government has to be formed. A no vote, on the other hand, is quite likely to put Greece on some sort of path to an exit from the euro. Typically, share markets don't respond well to negativity and uncertainty, and there's been a bit of a sell-off on markets over the last few days in response to the developments. Despite being economically and geographically distant from Greece and Europe, the Australian market did fall about 4% over the last week of June. Clearly, developments over the next few days will have a significant implication for the Greek economy and, more importantly, its citizens. However, from an Australian investor's perspective, it's our view that the longer-term risks from the crisis are pretty limited. We don't believe Greece actually poses a systemic risk for the Eurozone or for wider global financial systems. Although recent falls on the share markets are relatively unsettling, we don't believe that recent developments in Greece change the longer-term financial market outlooks or risks to investors. So is a deal still likely? Our assessment is that a deal is more likely than not, for the simple reason that it's in both parties' interests to reach an agreement. For Greece, it's in their interests to avoid the economic mayhem that would follow a default and a forced exit. That would include a banking crisis and a bit of a credit crunch, plus a huge loss of confidence and probably further austerity. For the creditors, the reasons to reach a deal are to preserve their roughly $300 billion exposure to Greece and to head off any blow to the confidence of peripheral countries. In this regard, while there's no decent comparator, the best way to look at it is that it's relatively similar to the war of words that escalated around the US debt ceiling, where politicians on both sides were arguing, but at the end of the day it all ended in a deal. Our assessment remains then that a deal is more likely to be reached than not, and that there's been developments this week which are consistent with that being the case. We also think that probably once Greece does sign up and delivers on some reforms, that debt relief is likely to be offered by the IMF, which is also in both parties' best interests. So what is the problem with the banks in Greece? Well, there's quite a lot of uncertainty in Greece, as you can imagine, and the main one is that Greek citizens are pretty scared that they're going to wake up one day and their euro bank deposits are going to be turned into drachmas, which are worth about 50% less. So as a result, they've been taking all their money out of the bank and sticking it under the bed, and that has led to the forced closure of the banks. So if there is no deal, will there be an automatic exit by Greece from the Eurozone? If there is no deal, Greece will be declared to have defaulted sometime in July. There's two possible scenarios here: a default but no exit from the Euro, or default leading to an exit. You might notice I haven't said Grexit. I think that's a silly word, so I'm going to try and avoid that where possible. A Greek default would not automatically mean it would have to leave the Euro. Much would depend on what the European Central Bank offered in continual support to Greek banks. Any continued support is likely to be limited, plus the loss of confidence and the likely downward spiral of the Greek economy would add pressure on the Greek government to sign up to a deal. However, if the ECB support for Greek banks evaporates or is limited and no deal eventuates, in order to avoid even more aggressive austerity and support its banks, Greece is likely to want to decide that it may want to print its own money. It can't actually do this within the euro, and so at that point it would have to exit. This, however, would take some months to unfold, and it would be fairly disorderly, and this would be quite negative for financial markets in the interim and very bad for stability for Greece. So what is the risk of this situation spreading if there's no deal? If Greece does default, as looks likely, the risk of contagion, and that is the spread of a GFC-like situation where financial institutions stop lending to each other, resulting in the freezing up of lending conditions, I believe it's actually quite low. Basically, the private sector, so companies, mums and dads, their exposure to the Greek debt is very low at around $50 billion. The vast majority of the debt, over 80% of it, of the Greek debt is held by the European Union, the European Central Bank and the IMF. Additionally, because the private sector ownership of Greek debt is so small, Greece may feel that it doesn't want to default on this portion of the debt to try and keep potential access to private markets open. This doesn't mean that there may not be some exposure through super funds and personal investments, but it's very low. The main reason that there is a concern that Greek default and Greek exit may lead to further contagion is a concern that investors may look at other countries in the region who may be next. There was a lot of concern around that in 2010 to 2012, but conditions are significantly different now. Mainly, Portugal and Ireland are now both off bailout support. Budget deficits in the primary countries where concern was held, Portugal, Ireland, Spain and Italy, are now averaging about 4% of GDP in 2014, where they were averaging about 14% in 2010. And so what we can see is average public debt levels have fallen quite sharply as a percentage of GDP in these countries, and economic reforms on the way. So it's a very different landscape to what it was a couple of years ago. So what is the relevance to Australia? Greece is only 0.25% of global GDP, and it's a fairly small market for Australian exports. The direct impact on Australia is then virtually non-existent. Rather, the relevance comes via Greece's membership of the Eurozone and its potential to destabilise it and destabilise the European Economic Zone. That would likely cause some volatility for at least the rest of the year, you'd have to expect. The implications then of all this for an Australian-based investor are, in my opinion, as follows. If you have some share market-based investments and also some fixed interest type investment like bonds, now is certainly not a time to panic. Markets are pretty well aware of what's going on. Most of the concerns are factored in, and the long-term outlook for those investments, in my opinion, hasn't really changed. There may be some short-term volatility. So as a result, if you're holding a bit of cash, and if you're holding maybe a bit more cash than you should be, now's possibly not a bad time just to hang on to it and see what happens over the next few months. What you might find is that there are some buying opportunities over the next few months. Now, I'm not a big fan of timing the markets, so if somebody was fully invested, my answer would be that seems like a reasonable sort of position to be in. But if you did have some cash holdings, there might be some opportunities over the next few months. So, in short, don't panic and keep an eye on the strategies that you're taking. Your asset allocation should be where it always should be, and keep your eye on the longer term focus of whatever your goals and aspirations might be. So if anyone has any questions, then please feel free to give me a call, drop me an email, let me know if there is anything else, and as always, if you've got any other questions then please feel free to let me know. Hope everyone has a great weekend, and I will talk to you soon. Bye bye.